Okay, we will begin now. So good morning, afternoon or evening to everyone wherever you are around the world. So welcome to the third session of MSGA Academy, the Financial Literacy series. And today is the session 3 Fintech session. So before we start, next slide. So here are some house rules to follow. Do mute your microphones throughout the session to prevent disturbance for other participants. You can turn on your webcam if you want to, and it is advisable to insert your questions in the Slido link provided in your email or in the link provided in the chat box. Please be patient with technical difficulties and learn and enjoy your time with us today. And lastly, a gentle reminder again, please rename yourself according to your registered name in the Google form to ease the registration process and for us to record for the certificate of participation. So without further ado, let me welcome the speaker for today. And before we start, let me do a brief introduction. Our speaker for today is Ms. Lee Choo Chong. She's the director of the ETF and Innovation Lab at Affin Hwang Asset Management Berhad. She is the queen of Malaysia's ETF and she graduated with a degree in mathematics and started her banking journey in a Standard Chartered Bank, climbing from a banking apprentice to product manager in treasury products in 2 years. So after working for Standard Chartered Bank for over 3 years, she became the AVP of Investment Product in Alliance Bank Malaysia Berhad, whose accomplishments include launching new treasury products, 3 new investment products within 2 years, and led the implementation of e-treasury system as the project manager. She has also been recognized for her outstanding performance with AFG Spirit Award and AFG Marketing Impact Award. She is also responsible for 40% of all ETFs listed on Bursa Malaysia. She is now the director of Affin Hwang Asset Management's ETF and Innovation Lab, spearheading the efforts to bring Malaysia's ETF scene as well as the innovation for the company to the next level. So Ms. Lee Choo, the stage is yours.
Thank you, Melanie. All right, I think first of all, good morning, good afternoon, or good evening to wherever you guys are. I'm very, very happy and delighted today to be sharing with all of you about FinTech in Malaysia. But I think before I start, I want to say, a big thank you to Faris and team for inviting me and for doing a good job in organizing, this series of financial literacy workshop, which personally, over the experience of working in the financial industry for close to 13 years, what I realize is that because financial literacy is not taught in school, and most of us are taught by our parents, given that I'm assuming that all of us here are Malaysians. Malaysian parents typically teach you how to save, but it will never teach you how to invest, right? So what I will do today is to talk to you about the fintech scene in Malaysia, what it is, what are the products or investment solutions that have been derived or born after the era of fintech, and then just as a case study, what Affin Hwang has done on our side from an implementation of fintech's perspective. And last but not least, I will teach, share a little bit about how all of us here can actually learn how to build a portfolio of your own, right? So Melanie, if you don't mind, I'd like to share my screen. Okay, I believe all of you can see my screen, right?
Yep.
Okay, good. All right, so I am the type of speaker that likes interaction. I don't like to be talking to myself. So I like you guys to interact with me in the chat. So essentially, if you have any questions at all, just post it there. So this is not a lecture, yeah. So this is more of a sharing session, and I like you guys to ask me question, you know, as and when you have a question, and just put it in the chat box. If it's appropriate, I'll slot it in and you know, answer it immediately so that, you know, we don't get lost. Because sometimes I think that, you know, if we leave questions all the way to the end, you know, sometimes either you may have forgotten your question, or you know, along the way we forgot what we were discussing about. All right, so if you don't mind, you know, Melanie and Faris, you know, feel free to just get anyone or even yourself to just post your questions here, and you can even stop me at any point in time. All right, so good. Right, so this is, you know, before I start, you know, in all financial institutions, we must have our disclaimer, okay? So this presentation here is prepared by Affin Hwang from my team on behalf of Affin Hwang, and it is merely just a sharing, you know, session. And please do not take any of the things that I say as financial advice and, you know, go all in and start investing into any instruments that I mentioned. So you need to do your homework, okay? Right, so let's start right now. So what exactly is financial technology, or in short, fintech? Tell me what comes to your mind, you know, the minute fintech is actually, you know, been said. Put it in the chat. What do you think? What is the first thing that comes to your mind when you know, we talk about fintech, when we say financial technology or fintech? What is the first thing that comes to your mind? Fancy, okay. What else? Passive income, okay. Interesting. What comes to your mind when we talk about fintech? Techie, okay. AI, all right. Innovation, okay. Keep them coming if you have any more. Advanced, okay. Is it scary? Does it sound scary? Python, wow, are you a programming student? Data cam, okay. Robo advising. Okay, I'm surprised nobody says Bitcoin. Okay, cool. Good that, you know, you guys are you know, engaging with me and telling me what you think. Yeah, so financial technology, you know, or people in short likes to call it fintech. Essentially, it's just you know, things that we do, you know, combining technology with financial. So what technology does is to help find the financial industry to make things faster, more cost efficient, and easy to use, right? So essentially, that's how, you know, fintech is born. It's just simply integrating technology into financials. So that's when, you know, we have all this machine learning, AI, artificial intelligence, algorithms, and programmers will combine what they can do from programming perspective and implement it in the financial industry. All right, so that's what we call fintech. And ultimately, the main objective of this is really to automate financial services and try to improve the processes. Okay, so today we know, I'm not too sure, you know, some of you who are, you know, overseas, when your parents try and remit, say, you know, money to you, your pocket money, what happens is that you realize that, you know, today your mom or dad will be remitting ringgit from a Malaysian bank, and it will send it over, let's say, to US, you know, in US dollar. And you realize that, you know, the remittance of funds doesn't come instantaneously, right? It usually takes maybe a couple of days, and sometimes if you have experienced this before, it may get stuck somewhere in the clearing or agent bank, and it may take, you know, up to 1 to 2 weeks before one can even receive the money in the other region or the other countries that you are in, right? So because of all this, and you know, fintech has stepped in to basically make it so easy for someone to just remit money from, say, in Malaysia to the US. So those are the little things that, you know, anything that you can think of from a financial perspective, I think somebody one day would have, you know, implemented it using technology. So at the end of the day, what, as a result or outcome of implementation of fintech, you end up with, easy access, things or products, investment products that are used to be, say, for the high net worth, for people with a lot of money, are now broken down into smaller investment amounts so that you and I can now access these investment products or instruments. Number two, it's cost efficient. Why is it cost efficient? Because with the use of technology in anything, right, in any processes, you realize that you need less human resources, you need less manpower to process transactions. In the past, banks hire lots and lots of, tellers, clerks, and things like that, trying to help them process payment. But with the help of technology, everything can now be cost efficient because everything is automated, right? And of course, we are now living in the era of, owning a mobile app, handphone and mobile app is like a must, right? So it definitely has to be easy to use. Otherwise, nobody's going to adopt it, right? And last but not least is convenient, because wherever you are, in whichever region or whichever country, you can now access to products or services where it is based offshore, and you no longer need to, say, book a flight ticket and then fly over to that country to start investing into those products. But before I jump in and share with you what are the types or of products that are in Malaysia that have been born as a result of the implementation of fintech, is that I want to talk about investing in regulated fintech in Malaysia. Okay, the reason why I bring this up is, even though today we are living, in a way, you can say that it's a borderless, world, where today with fintech, you're supposed to be able to, say, open an US account, open an Australian account, etc. But beware, or please take note that you must try to invest within what is permitted in your country. And the reason for that is actually very simple. So later on, I will talk a little bit about Bitcoin, about cryptocurrencies, and how, when you as an investor investing in a product or a platform that is not authorized or approved by the Securities Commission of Malaysia, who is the regulator of investment products here in Malaysia, you will get into trouble, because Luno, okay, of course, now they are licensed and regulated by Malaysia. How many of you here have heard of Luno? Can you either raise your hands or put in the chat, type in yes? How many of you here have heard of Luno? Anyone heard of Luno? Okay, not that many. Okay, right? Just the name only. Don't know what they do. Okay, cool. You guys are quite well informed. So now that you have heard of Luno, basically Luno is a platform or an exchange that allows you to trade cryptocurrencies. So I think maybe 2 years or 3 years back, Luno was not regulated in Malaysia. I think they were regulated in the US, and they actually offered Luno platform. They basically offer it to everybody, anybody in Malaysia. As long as you have a mobile app, you can download the Luno app and you can start trading your cryptocurrencies using Luno, right? But what happened was, because they are actually not regulated by SC, SC can eventually stepped in to say that, hey, this is not a regulated entity in Malaysia, and because they are taking money from Malaysians, they actually freeze the bank account of Luno. So if you have invested in Luno, all right, and you're trying to withdraw or sell your Bitcoin and withdraw it in ringgit, you get stuck. So Luno was unable to make any payments or withdrawal proceeds back to the investors, because the Securities Commission gave an order to their bank, I think that time, if I'm not wrong, was Maybank, to actually stop transactions. So as a result of that, as an investor, your money is still safe per se with Luno, but it may get stuck. So you may not have that liquidity. You will not get, you may not get your money back as fast as you thought it would be. So these are some of the reasons why I always tell investors to make sure that they invest into platforms that are actually regulated by Malaysia. I mean, there is a reason why all these regulators actually exist. And their primary role is really to try to safeguard Malaysians' interests when it comes to investing. Because nowadays there are so many scams out there that could result in investors losing their money. So even though these platforms can be regulated outside of Malaysia, it does not mean that it is safe to invest. Okay. Now, so what has happened is over the course of 3 years or so, when SC tried to liberalize, then we realized that there are now more and more fintech operators or players in Malaysia, out of which there are actually 7 digital investment managers. So digital investment managers are your typical robo-advisors. We have 1 digital broker who are allowed to be trading, allows investors to trade shares, and 1 online fund distributor, and as well as a different set of license or operators. They fall under the registered market operators, and typically there are a lot of them, like 10 equity crowdfunding platforms. There are 11 P2P financing platforms, and 3 digital asset exchanges, and 2 e-services. Later on, I will go into into details as to what they do, so that you get a little bit of light as to what they do and whether or not these products could eventually be of interest to yourself. Okay. All right, so let's talk about the hot topic, cryptocurrencies and blockchains. How many of you here have invested into a cryptocurrency? Can I see a raise of hand or a yes in the chat? Let's see. Not many, huh? Okay. Too risky. XRP, okay. Okay, cool. Not that many. I'm surprised because I hear when people talk about fintech, the first thing that comes to mind is Bitcoin. So some says that too risky. Some says that seems to have a lot of hackers out there. You are right. So this will somehow tie into the last topic or last section that I'm going to drill into, which is how do you build your portfolio. Okay, now let's talk a bit about cryptocurrencies and blockchain, exactly what it is and stuff like that. I'm not going to drill into the details because if you're really interested, it's a lot that you can read about. In fact, that is what I'll encourage all of you to do, because there are many people here out there who can be very lazy. When their friends say, hey, buy this, sure can go up, I've made how many percent, and it's easy money. A lot of times, many people, because they are FOMO, right? Fear of missing out, and they just jump in without doing their own research and understanding of the product. So that is definitely not my advice. I would strongly encourage all of you, because I mean, in the past, during, your maybe, I think for you guys, it could be your grandparents' generation, right? Where they may not be, too well educated. And as a result of that, they do a lot of things or a lot of decision based on hearsay. But now we are in this era where everybody is educated and every one of us know how to read, right? So go read the prospectus, go read whatever documents that are out there and do your research. Okay, but don't go over the board as well, yeah, because I realize that there are some investors who go over the board and they seem to then after that fence out all the risks and they say, okay, never mind, I think it's better for me to keep my money in the fixed deposit, which is also, if you ask me, not a very wise decision. Okay, so let's talk go back to cryptocurrencies and Bitcoin. So what exactly it is, as you can see, the price for 1 Bitcoin since the December 2015 has gone up 14,000%. just over 5 years. And that's really, really crazy if you ask me. It was trading at a 416 US dollar, and now I think the price has came off a little bit, but it's still hovering, I believe, at above the 50,000 US dollar mark, right? And that's just crazy. So what Bitcoin is essentially, it is just a platform for people to make transaction, for people to make payment from one to another. And if you like, you can think of it as a digital currency. Okay, if it's a digital currency, then the reason why Bitcoin kind of took off, it's also not from the traditional banking or conventional fund management side, simply because Bitcoin is just a digital currency. It doesn't do anything. It's, if you like, you can treat it as if it's gold. Okay, you know, gold doesn't have too much of a commercial usage, and people just hold gold because it stores value. So this is what happened to Bitcoin in a way. But because there are people who like the fact that how these transactions are being done, and they can mine it and things like that, it got popular and the price just shoot up. But if you really go and dig as to how many institutional investors are invested in Bitcoin, I will tell you that the percentage is very, very low. Okay, so primarily it's really driven, the price increase has been driven by the retailers, by people like you and I. Okay. And in this, cryptocurrencies, at the end of the day, because it's just a payment, so somebody just needs to initiate a transaction. And then you have the miners. I don't know if you have heard of people saying that they're mining Bitcoin. So when they say that they're mining Bitcoin, essentially they're just providing their hardware, their computer for data validation. So once they've checked that this transaction is valid, it is then approved, and the transaction will now be recorded on a blockchain. Right, so essentially it's just a ledger. If you look at how different banks control their own transactions, they have their own ledger. Everybody will have their own ledger, but they are all built using the old technology. And Bitcoin was the very first use case or test case that they have implemented this blockchain technology, and it has proven to work. Right. And it's not owned by anybody. Okay, it's not like it's not like a currency, not like ringgit that's issued by Bank Negara. Bitcoin is really just a peer-to-peer payment platform. Right. So what are the benefits and risks of investing into cryptocurrencies? So as you can see, it is accessible, it is something new, and you can invest in fractional. Right, so you don't need to own one Bitcoin, because one Bitcoin is 50,000 US dollar. So you can own as low as 0.00000 whatever one coin. Okay, and it's secured because of the fact that it is all traceable. So as you know, like I mentioned just now, it is all on this blockchain. So all transactions are actually recorded. So actually some people say that people use it for money laundering, but actually it's not so easy to launder using Bitcoin, simply because if everything is recorded, and anybody who has the key can actually go in to verify transactions and check who the payer or payee is, then it is actually not as easy as we think when it comes to that. Of course, transactions can be done through blockchain, and it allows payment to be made from one wallet to another much, much faster than a conventional bank. So I think one of my colleagues actually said that he was trying to pay his son who is studying in the US using Bitcoin. And when he did the transfer of the wallet, it's instantaneous, right? And like the very beginning, when I mentioned about conventional banking, when your parents remit money from you in Malaysia and ringgit to US dollar in the US, it can take up to 1 to 2 weeks sometimes, right, if it's slow. Now, what about the risk? Some of you just now mentioned, say to me that, hey, the reason why I never invest into Bitcoin or cryptocurrencies is because it is risky. You are absolutely right, because the prices can be very, very volatile. So a lot of conventional investors would not really touch Bitcoin because it doesn't have any fundamental value. I don't know if all of you here have heard of Warren Buffett, which I believe all of you would have heard of Warren Buffett. And Warren Buffett will be one of that those type of conventional fund manager or investors that will never believe in Bitcoin, because Bitcoin just doesn't have a fundamental value. Unlike companies like Coca-Cola, like McDonald's, they generate revenue. So a typical conventional investors will probably not touch cryptocurrencies, all right? Now, and sometimes it can come with high transaction fees, because you have to essentially make payment to the miners for them to verify and process your transaction. So these miners who owns computers, essentially they are basically just lending their computer or the hardware to these people who wants to transact, because they validate the transaction. So essentially you are actually loaning your computer out, and that's what we call them miners, all right? And as a reward of it, you get to mine Bitcoin. So that is your reward when you mine Bitcoin, okay? And somebody brought this thing up as well, which is the risk of your wallet being hacked. I think some time back we've heard of a news where this guy has got, I don't know, millions or billions in Bitcoin, and what happened was he forgot his password. In the e-wallet for Bitcoin, apparently, so it's not like when you log into your email or wherever and you have this function called forget password, right? And then you get to do that, but for Bitcoin, it's because it's so secure, in a way secure, and as a result of this person forgetting his password, he just cannot retrieve his wallet anymore. All right, so that is also a risk. And with the rise of phishing emails, you will know that hackers will come in and pretend to say that hey, do this, key in, give me your password, and things like that. And some people who are not as alert may probably end up giving their password out. Okay, now so let me give you an example. So just now I mentioned about Luno. So Luno is an example of one of the approved digital exchange in Malaysia. So if you're in Malaysia and if you want to trade cryptocurrencies, I believe now they have 3 or 4 cryptos offering, and you can actually trade it legally via Luno, because they are now regulated by the Securities Commission. Okay. So guys, as I talk, please, if I'm going too fast, please tell me in the chat, yeah, because sometimes, when I talk, I just, talk very, very fast. And if you have any terms that you need to clarify, please type it in to the chat as well. Okay. All right. The next product or the next platform that I want to introduce to you is called the equity crowdfunding. So what essentially is equity crowdfunding? Okay. So today, if you look at how a company is being listed on a stock exchange, essentially these are just companies. Let's say, for example, if I own, let's say, a restaurant. Okay. If I own a restaurant and I'm trying to raise funding from people so that I can expand my restaurant, there are many ways to do it, right? You can either get a loan, okay, and issue a bond. Okay, that's what option 1. You can also go to the stock market to list your shares to on the stock exchange, so that people will then buy some shares of you. Then they become like a co-owner of your restaurant. And the third option that they have now is actually to go through an equity crowdfunding. But of course, in Malaysia, equity crowdfunding has its limitation. I think maximum they can probably raise somewhere between 3 to 5 million ringgit. So of course, if you are still going on a massive expansion, listing it on the stock market, or going going directly to private equity firms, the big ones, would be the other option. So equity crowdfunding was actually a result of investors realizing that their businesses generally SMEs who do not need large funding, and they don't need to, list their shares in the stock market, but they need funding, right? They don't mind giving out some of their shares so that the revenue can be shared with these owners who contribute funding to their company. So what the equity crowdfunding platform did was they became the middleman. So in other words, they are like the stock exchange, right? So they become the middleman, trying to match investors with the businesses, small businesses that requires funding. So they will do the due diligence. They'll make sure that, these people or these companies trying to raise funds, their funding is what they will use after they raise their funds, whether is it for expansion plan, whatever it is. And they will make sure that these companies are, not a scam, and they are legit companies. So the equity crowdfunding platform will actually do their due diligence to make sure that everything is in order. And then once they have done their due diligence and things like that, they will then bring this company to the platform. And as an investor, say for example, you can register yourself in any of this crowdfunding platform, and you can now then look at this business, and if you like them, you can actually start investing. And if I'm not wrong, the investments start from as low as 100 ringgit. So these are products in the past where it's only accessible, is what we call private equities. They are only accessible to investors who have large funding in the past. But now they've broken it down and making it affordable for retail investors to participate in it. But of course, it comes with risk, right? So as much as we say that, the minimum investment is low, but you have to note also that these companies are generally your SMEs, your small and medium enterprise. So what happens is that when you invest into a SME, you generally take on a higher investment risk, because these are less established companies, and definitely in any investment products, there are no guaranteed returns. And one of the downside of investing in equity crowdfunding is the fact that the shares are illiquid. So unlike shares that are traded on Bursa, you can just buy and sell at any time during the market is open, right? So if you trade on Bursa, you can trade from 9 a.m. in the morning all the way up to 5 p.m. But equity crowdfunding, they behave like private equities. So as a result of that, the shares are illiquid. There is no secondary market to it. Okay, yeah, something like Kickstarter. Yes, you are right. But I think, if I'm not wrong, Kickstarter, they don't give you shares in return. I think they give you the product, so you pay them, be one of their early buyers of the product. If I get it right, yeah. Okay. Third, of course, there are no short-term returns, because you typically will have to lock these investments for at least 3 to 5 and sometimes 7 years. Okay, but the returns, given its illiquidity, would actually be a little bit higher. Okay, what is an IPO? Okay, IPO is initial price offering. Essentially, what it means is it's a company, for example, let's say, Coca-Cola in the past, they want to raise funding, and maybe don't talk about Coca-Cola. Coca-Cola is so dated, right? Let's talk about Grab. So if you have been reading the newspaper, you would have heard and saw that Grab is actually looking to go on an IPO. So what essentially it means is that they are trying to list their company on a stock exchange, so that investors can now buy and sell shares of Grab. So when you own shares of Grab, which means that you are now part of the Anthony Tan's family, right? You are one of the share owner or own a part of the company. So you take, the profit that you generate, that Grab generate as a result from that. Okay. All right. Equity crowdfunding in Malaysia. I'll give you an example. You can actually go to SC's Securities Commission website. They actually list down all the regulated parties of each section, like equity crowdfunding, peer-to-peer financing, a digital broker, etc. is all in the list. So go through the SE's website and see which platform could interest you. So all these are, I think equity crowdfunding, just now we mentioned there are easily like 10 or 11 of them in Malaysia. I'm just simply pulling one of it out. It's not a recommendation to go with these guys, yeah? Okay, so one of the example of an equity crowdfunding platform is Atta Plus. And Atta Plus invests in Malaysian startup and SMEs. Okay, like what I say, yeah. And year to date, they have actually raised close to 200 million in Malaysia as of December 2020, and 61% of their investments are actually made by retail investors. Okay, so you realize that this type of platform will typically have more retail investors invested into it. Okay. All right. Before I continue further, Faris, what time should I stop?
So preferably we would like you to stop at 12:15 p.m.
Okay, 12:15. All right. Okay. I think it would be just nice. Okay, next. P2P lending or peer-to-peer lending. What it is? Just now I mentioned that if a company wants to get funding, to raise funding, they have two options, right? You either get a loan or issue bonds to raise funds, or the other option is to sell your company stake, which is your equity or your shares of your company, so that other people can also be owners of your company. Now, equity crowdfunding is the equity route. P2P lending is the bond route, which means that essentially it's no different from you borrowing money from a bank. But instead of borrowing money from a bank, you borrow it from a peer, right? That's why it's called peer-to-peer lending. So when you borrow money from a peer, it means that, it's just like you and I. So if I need money and I'll go to Faris and say, Faris, could you please lend me $100? And if, Faris agrees, then we can say, okay, let's sign on this agreement and I'll repay you back, next week when my parents, remit money to me, for example, right? So this is what we call P2P lending. So P2P lending, again, typically, because the platform providers saw, a space, which is your SMEs again, right? The small and medium enterprises wanting quick access to loans, but they could be tied down because most banks do not want to lend out to SMEs. Right? Banks can be more conventional. They do not want to take risks because they are afraid that, these guys could end up not repaying their loan and stuff like that. So because of risk management, they then do not, typically lend out to them. So what happens is that in a P2P lending scenario or ecosystem, a company who wants to get funding will then go to the P2P lending platform and say, hey, I need to raise or to borrow 1 million ringgit. All right. For the P2P lending, there are only two cases that, or rather two purpose that the SMEs are allowed to borrow money. I think first of all is for invoice financing, which means that today, most of the small SME companies would have this thing called credit terms with their, distributor. Let's say, for example, I produce eggs, right? And I'm selling my eggs to Tesco. Tesco will not pay me immediately when I supply the eggs. They get usually like a 90 days credit terms. Okay. So as an SME company, I need the money to buy more eggs or to, buy more chickens to farm more eggs, right? So what I have to do is I can then, of course, go to a bank, but sometimes if bank doesn't want to, lend me the money, I can then go to this P2P platform and say that I need, an invoice financing worth say 1 million, because I know Tesco will not run away, right? Tesco will pay me in 90 days time. unless of course Tesco goes bust lah, right? If they go bankrupt, then I'm in trouble. But if not, Tesco will pay me back in 90 days, and I get this funding, and I can then repay to the investors or to this P2P lending platform. So the P2P lending platform then now acts as the platform, again, similar to equity crowdfunding, to match investors with companies who wants to borrow money. So investors in this scenario, you do not own the company like in equity crowdfunding. You are simply just lending money to this SME. Okay. So and the beauty of P2P lending is that returns are stated. Okay, just now, in most of the equity scenario in shares, we do not typically, promise or guarantee a certain return. But because this is a lending like bond, right? Usually when you buy a bond or when you invest into a bond, there must be a fixed coupon that they pay. Okay, coupon is like your interest. It's like when you deposit money into the bank, how much, what is the percentage of interest that they will pay to you. So in this case, because it's a loan, you will know the interest upfront. So given that the risk, again, goes back to risk, given that the risk that an investor is taking in this scenario is higher than you, say, putting or depositing money into a bank, therefore, the interest that they seek to compensate to investors as a result of the risk that you take is generally higher. And it can range from anywhere between 8% all the way to 12%. So I personally have invested some of my investments into P2P lending. Not big amount, I was just trying it out. And as a result of it, I do have companies which defaulted. They may not have defaulted, but because of MCO, they are unable to recuperate their investments, or rather they did not manage to collect payments for the service or the products that they have sold. So as a result of that, they won't be able to repay me as an investor. So in this case, it means that whenever you are investing into P2P, don't get too excited about that return that you see, but very importantly, you need to diversify. So if you think of yourself like a bank, banks don't loan all their investments or all the funding that they get to a single counterparty. Right? So we have to spread out our risk so that in the event if one counterparty defaults in payment, then maybe if you cap your risk to, let's say, 1%, so you can only invest 1% into this particular company or loan your money into this particular company, then you can manage your risk. So I think at the start when they were talking about P2P, people get excited. And again, as retail investors, we need to, be smart about it. We need to make sure that we assess risk from different angles. Okay. Now, what happens when the SME default? This question I just explained that. And what considerations will allow one SME to prefer over the other? Are you referring to, as an investor's, from an investor's perspective, what should you consider when you loan money to this SME? So for me personally, you need to actually look at, the track record of this company. How long have they been in existence? What industry they are in? So I think different platform gives you different information. Again, I think there are 10 to 11 P2P lending platform in Malaysia. So like one of it that I tried to invest myself, they typically do not disclose the company name. So unfortunately, when they don't disclose the company name, you won't be able to do really deep research because you don't know who they are, right? But they only list things like, the industry that they are in, whether they are in manufacturing, garment manufacturing, or, restaurants, hawker stalls, etc. They'll give you information like that, and then they will give you, their whole year revenue, their turnover, and from there you can then look into selecting. Other than that, these platform providers, these P2P lending platforms, they also actually have ratings. So they have their own credit rating for different companies. So they rate the companies that they offer on their platform. So they call it, grade A, grade B, and grade C. So you can see that, grade A simply means that they've done, the P2P platform has done their homework, they have assessed the company, and they think that this company deserves a grade A rating. But it doesn't mean that this rating doesn't deteriorate. When they are in grade A, they typically place lower interest as compared to a company who is graded at C. Okay, because C means you take on a higher risk. Okay, all right. Let's take on these two questions. Is venture capital the same as equity crowdfunding? Yes, similar, except that venture capital typically is run by a bigger setup, whereas equity crowdfunding is run by a smaller setup because, like I said, in Malaysia, there are limits to how much one can raise from the equity crowdfunding platform. If I'm not wrong, it is capped at a maximum of 5 million ringgit. So if you want to raise like billions or millions of dollars, you have to go to a VC, a venture capital, rather than an equity crowdfunding. Okay. Okay, Yishan says that actually I'm asking if a company will prefer P2P over equity crowdfunding. I see. Okay, so from a company or SME perspective, whether to decide to go for equity crowdfunding or lending, usually it is quite straightforward lah, right? So if they know that they need this funding for shorter term, generally, because for P2P lending, usually the tenure is quite short. It could be 3 months, 6 months, and I think maximum a year or 2 years, if I recall correctly. So when you do lending, you know that usually is for the shorter term. But for equity crowdfunding, usually they want to do expansion. It's usually for the bigger tickets, right? So for example, if you are doing, let's say, you are an ice cream seller, right? Maybe you are inside scoop and you're trying to research and do come up with new flavors, and you may need money to spend on buying, say, machines, buying all the ingredients, doing all your testing, your research and stuff like that. And because these and the returns may come in over the long term, right? Because it takes time for you to research a new product or a new flavor. And because of that, usually people will then go for equity crowdfunding if it's for the longer term, because it doesn't make sense for you to, say, loan money and you don't even know whether the returns are going to be there or even it's going to be successful. Okay, hope that answers your question. Now, so the P2P lending, I think I've covered it, over the course just now, that previous slide, the good, what are the good and what are the bad. So essentially the good of it is that, again, this are broken down into small investments. So I think you can invest from as low as 50 or 100 ringgit, basically lending your money to these SMEs. But the risk that you take, again, could be higher, all right? So don't just look at the returns that you can potentially get. So funding societies is one of the P2P lending platform in Malaysia. And as of April this year, they have actually raised or financed 6.53 billion in terms of the loans that they have facilitated. And their default rate, okay, as you can see here, is at 3.27%. Okay, it simply means that if 100 companies or 100 loans that they've given out, 3.27% are unable to pay back the loan. All right. Okay, next, we'll talk about digital brokers. How many of you here have heard of Robinhood, eToro, Interactive Broker, Tiger Broker? Have you heard of any of these companies? Yes, I see people raising hands. Okay. GameStop. Yes, okay. GameStop is the company, not the platform, yeah. Okay, so we're talking about the platform. So if you know or if you have heard of GameStop, which means that you would have which means that you know what is an IPO, you know what is an equity and or share. So digital brokers at the end of the day just provides you a platform to buy and sell shares. they are not new. These are industry that exists many years ago, because in Malaysia there are like easily 10 to 15 conventional brokers out there. So you have, you know, your Maybank, you have your even Affin Hwang has got a broking business, you have CIMB and the likes of many of these people. And what happens is that I think 3-4 years ago, Rakuten Trade came on board in Malaysia. So Rakuten is a joint venture between Kenanga Investment Bank and a Japanese company called Rakuten. And when they you know, do a JV in Malaysia, they wanted to offer their brokerage business fully online. Okay, so today, if you have, you know, or even your parents have opened a brokerage account with a broker in Malaysia, they typically still have to sign form. You still have to meet someone or go to the branch to open a trading account for you to trade. But again, with the help of technology, this is you know, another example of implementation of fintech, where they cut out the human beings, right? You don't need remisiers, you don't need people to see you to do an account opening. Everything is done online. So all you need is to just download their app or go to their website and open an account fully online. All right, and the things that they offer are, you know, very simple, is exactly the same as what a conventional broker would do, which is to allow you to buy and sell stocks, right? Generally stocks. And sometimes, depending on which broker, it may give you access to different exchanges. Okay, and there are also access to research reports that can help you do your research. Now, the good and the bad for digital brokers are definitely the fact that it is convenient because you don't need to go to a bank. I think especially in Malaysia, the pain to open a brokerage account with a traditional broker, it's quite painful. Sometimes your account can only be opened 2 weeks or a month later. So if you're an investor and if you have something to invest in, like now, you won't be able to do that with a conventional broker. So if you have a digital broker who can open an account either instantaneously or takes maybe 2 to 3 days to open the account, then, you know, it's easier for an investor. And there are also cost savings, because generally digital brokers, again, you don't need to employ so many human beings. Then therefore, there will be a lot of cost savings, and they typically charges lower brokerage fees. Okay. And when it comes to risks, they are just, you know, the exact same risk as you buying into any stocks or any companies, equities listed anywhere in the world, right? So like I said, Rakuten Trade is the first. I think they launched in 2017. And their fees are relatively low. So instead of charging a percentage, I think they charge a flat fee. I think 7 to 9 ringgit, if I'm not wrong, per transaction. But they do have a cap of up to 100 ringgit per trade. But I guess 100 ringgit is for if you trade like 100,000 or something like that lah. Okay, so what it does is, you know, allows you to trade. It gives you access to reports, research reports, so you can read, and you can also do transfers, and it is regulated by the Securities Commission. So there are now two, I would say, digital brokers. One is Rakuten Trade, the other one is Fund Supermart. Okay. Now, I know last session, Ken came on board. I know Ken from Stashaway. So we will talk a little bit about robo-advisors. I will just, you know, kind of go a little bit quicker, since I'm going to assume that all of you have attended Ken's session where he covers, you know, robo-advisors. So robo-advisors, at the end of the day, are just trying to, they are trying to kind of like replace the conventional fund manager, like the company that I work in currently, Affin Hwang Asset Management. Well, they are just trying to, again, digitalize the entire process, right? What they do is essentially they offers or facilitates online account opening, because like if you want to buy a unit trust fund, you still have to open an account with a unit trust consultant or agent. And in this case, you do not need to meet any human being. Okay, I know people of your generation don't want to meet people. right? You don't want to go to the bank. You don't want, I mean, even my generation of people like me, I also don't like to talk to people. Okay, if I can do my banking, everything online, I'll do it online. I don't want to go to the bank. Okay, and I think I consider myself young. So how essentially robo-advisors work is that, number one, they digitalize the entire onboarding process, including the investments, and they also would employ some algorithm in fund management. So like for us, our fund management is done by a human. Our chief investment officer and the entire investment team looks at the market, and they will do their research and then decide what stocks to buy or sell. But robo-advisors, on the other hand, uses algorithms to run. So again, as a result of it, they would be able to save a lot of resources, human resources, and therefore they can actually offer a cheaper fees for investors. Okay. So I'm just going to skip quite a fair bit of this. So as an example, I think StashAway was the very first robo-advisors that got their license in Malaysia. There are actually 7 licenses that was granted, but I think the most active ones are just probably a couple, like StashAway, Wahid Invest, who is an Islamic robo-advisor in Malaysia. And then you have Maitio, who is a joint venture with a Japanese company, and Akru, which is relatively new. Okay. Okay, now let's talk about online unit trust fund distribution. So some of you, here may think that, hey, are there people, who still buy unit trust funds? I thought unit trust funds is like, the outdated, investment products, and they are not in trend. But I can tell you that if it's not in trend, our company or any of the asset management company in Malaysia would not have been growing our AUM, our assets under management, which means the amount of money that investors give to us to manage, grow on a year-on-year basis. Okay, so unit trust funds are generally suitable for investors who are new. Okay, when you don't have a lot of experience, when you don't have a lot of time to do your own research, you can then engage a human being. Okay, whether be it meeting face to face, or it could be a Zoom meeting, and try to get advice from these people, from these consultants. And there will also be a professional fund manager that helps you manage your fund. Okay, so one of the benefits of the unit trust funds online is the fact that there is actually a wide variety of products for investors to choose from. There are complex products like what we call wholesale funds that investors can choose. If not, you can go with the retail unit trust funds. Other than that, because it used to be at a higher investment amount at 1,000 ringgit. But what Affin Hwang has done is that we have launched a mobile app that allows investors to invest from as low as 50 or 100 ringgit. So given all this, and we have also reduced the sales charge that we charge. So if you look at this will be more or less, I would say, a product that you can compare with, say, StashAway. Right? StashAway invests into ETFs, but by investing into unit trust, they are more or less the same. Of course, there are differences when it comes to fees. Okay, but I would say that fees is not everything. Okay, low fees does not equate to everything. Right? It doesn't mean that it's good because it's cheap. Okay. Now, so this is just like a case study that that I want to explain what we have done in Affin Hwang. So we launched this app called Allocate Plus by Affin Hwang Asset Management. So what we do here is that we try to compete with StashAway. Okay, it's not it's essentially a conventional fund manager trying to step up our game and trying to make ourselves more better to cater for future needs. So we have also moved on to offering online investments. So what essentially you can do is you can do online account opening. So as long as you have an IC, you can actually do a full online account opening experience. You don't need to talk to anybody. You can then, after opening an account, straight away invest into a unit trust fund. And in this application that we have built, we have also built what we call a combo portfolio. So for those investors of you who like to do your own research, there are people who like to read up, right? They are interested in investment, they are interested in finance, and therefore they will like to go and read up, a lot about how do I build a portfolio for myself? What should I invest in? Should I invest into US equity market? Should I invest into the China equity market? Should I invest in gold? Blah, blah, blah. And if you are interested in that, in building your own portfolio, then in the Allocate Plus app, you can actually pick and choose what investments you want to build your portfolio. Or alternatively, if you think that, hey, I don't know what I want, we also have what we call combo portfolios. They are like your McDonald's value meals, where it's all pre-packaged into a combo for you to choose from. Okay, and of course, we are regulated and licensed by Securities Commission. Okay, let me address Ming Chiet's question on Rakuten. So he asked, do we own the stock in our CDS account when we trade using Rakuten? Yes, you actually own the shares when you invest in Rakuten. So I believe maybe you asked this question because some of the broker per se, say eToro or even whatever Tiger Broker, etc. Sometimes you realize you may not have realized that you are actually not investing into stock directly. You are investing into CFDs or contract for difference. So this could be a really totally different asset class that we're talking about. So which is why I always encourage investors to read before you start investing, because if anything happens, the claim, what you can claim from and things like that could be very, very different between these different asset classes or products. Okay. Now, Shishan asked, what are the differences between ETF and unit trust? I don't have time to go through the entire thing fully, but typically unit trust unit trust is actively managed. Okay, whereas ETFs are index tracker. So I'm sure all of you here have heard of index like FBM KLCI, which is the Malaysian stock index, or you have heard of the biggest, which is S&P 500, right? When you talk about the US market, people will talk about the benchmark, which is the S&P 500. So an ETF tracking the S&P 500 index will simply just mirror the 500 stocks in the S&P 500 index. Okay? Whereas in a unit trust fund, because it is actively managed, which means that there is a fund manager who will look through, thousands of stocks listed in the US, for example, listed in the US, and then do analysis on each and every one of the stocks, and then decides, okay, I will not take all 500 stocks of this S&P 500. I will pick the ones that I think, based on my analysis, that will do well in the future. So unit trust fund is actively managed. It is decided by the fund manager what stocks to be included into the portfolio. Whereas the ETF tracks a particular index. Okay, so it will just mirror. The reason why the fees are lower for ETF versus unit trust fund is really because of the amount of work that is required by the fund manager. In an ETF environment or setup, the fund manager don't need to crack their head, think about, oh, what stocks should I invest today? What stocks will do well? Because all they do is just open up the index. Okay, if this index has got 500 stocks, I will invest in 500 of them. And my objective is to give you a performance that is the same as the S&P 500. Because when we talk about the index, we can't invest into the index, okay? Because it's just a reference benchmark. So ETF is derived or is born as a result of giving investors that option to invest into that index. Okay, so essentially that's an ETF. And unit trust fund, because the fund manager have to crack their head, think, what should I buy, what should I sell? And the amount of work is a lot, right? And that's why the charges are also different. Okay, and unit trust funds have a different objective. The objective is to beat the benchmark. Okay, so if I'm tracking or benchmarking myself with the S&P 500, my objective as a fund manager, the unit trust must beat or outperform or deliver higher return than what the S&P 500 would give you. Okay, all right, cool. So this is a case study, again, like I said, of our Allocate Plus app. So after this, you can, go ahead, go to your Play Store and all, and go and download. You don't need to have an account in order to browse, because we made it available for you to continue as guest. So you don't need an account. So you can just go in to take a look and see, how it's like, and experience it yourself. Now, I would like to end with this process. So when we talk about building your own portfolio as an investor, today you can still take time to learn. There's nothing wrong with it. You guys are still studying, right? But it's good to know from now, because once you start making your own money, you need to then learn how to invest so that you can make your money work harder than you for you. So know your risk and objective is the very first step that I want to explain. So this journey is like a cycle, okay? So you have to start off with knowing your risk and objective, okay? And then secondly, determine how to asset allocate. Third, compare and select the products that suits you. And last but not least, invest regularly and monitor your investment. Try not to time the market, okay? So first thing, know your risk and objective very, very quickly. So you need to first ask yourself, why are you investing? Are you trying to save money, for retirement? Are you thinking of having kids? I think maybe not for you guys, since you guys are probably somewhere between 19 to 21. I don't think you have that in mind, but you could be thinking, hey, I want to save up to go for a holiday, or I want to save up so that I can buy things that I like, and buy a car, buy a house, etc. And then you need to ask, how long do you plan to invest? Right? 3 years, 5 years, short term. And one question you need to ask yourself is, what if you see your money or the value of your investments drop 20, 30%, or even 50%? What would you do? Would you withdraw? Would you do nothing? Do you feel nervous about it? Or would you invest more? Okay, some of us will say that, I'm okay lah. I will not, be bothered about it. But I can tell you, when it comes, you don't know how your emotions will be, yeah, because these are your hard-earned money, and many times investors actually tend to be jittery. So sometimes we think that we can tolerate a lot of risk, but in actual fact, we can't. So you need to really understand yourself and really answer it truthfully, not just so that you look macho, yeah? Okay. And would you be able to take on higher volatility? Volatility simply means the price swings. Can you see, like, one day it goes up 20%, the other day it goes down 30%? Okay. So these are some of the factors that will impact your ability to take risk. For example, tenure. The lower or the shorter the tenure you have, then which means you cannot tolerate high risk, because we know that high risk, high return, and you need to give it time. Okay, so tenure, the shorter the tenure, the lower the risk that you can take. Loss tolerance, the higher the loss tolerance that you can take, the higher your risk appetite is. Investment experience, okay, of course, if you are experienced, or if you understand the products that you are investing in, if you understand it fully, then you can tolerate higher risk, because you know what you're doing, right? If your experience is lower, because then you'll be jittery when price drop. You're like, hey, what's going on? What happened? What caused the price to drop? Then you'll be jittery, and therefore you should your risk tolerance should be on the lower side. And of course, the ability for you to take on the higher fluctuations in your return. If you think that, it's fine, I could tolerate it move a lot because I have a very long-term horizon, then again, your risk tolerance would be higher. Then next off, these are very, conventional examples of asset allocation, which again, if you Google asset allocation, you find tons of research with this. There's no right or wrong to asset allocation. To me, asset allocation is an art. I like to call it an art because, the asset allocation may work for you, but it may not work for me, despite us, having a similar risk tolerance. Right? Okay, because there are a lot of other factors, right? Like, for example, if I understand equities more and I'm comfortable, I can have a higher allocation to equities, right? So you need to understand yourself. You need to understand the instrument before you can decide on the asset allocation. Again, like I said, there is really no right or wrong in asset allocation. Then after that, what you do is you need to compare and select the products that suits you. Of course, my slides here gives you all the very conventional instruments, but you can expand your own list. For those of you who like to do your, checklists and stuff, you can, always put them down into the list. And then from there, have a look and decide what are the products that suits your personality, that suits your risk appetite the best. Okay. And last but not least, invest regularly and monitor your investment. So first thing first, of course, you need to devise your investment plan, right? You need to know how to invest and what happens when your investments drop, market drop, and things like that. So one thing that I like to advocate is to invest regularly, because even the fund managers, the professional fund managers, despite us looking at the stock market on a daily basis, we cannot predict any drop in the market. Nobody, if everybody is so good, then you're God already, right? You can predict everything that's coming. So that's not possible. They can, as much as, in the best effort, try to predict, but again, the prediction can never be 100% accurate. So as a result of that, for us as investors who wants to try and time the market, it is really, really difficult. So what I like to do is I like to invest regularly. So instead of jumping in, let's say if you have, 1,000 to invest, you don't jump in 1,000 at one go. You split it into maybe say 5 transactions. Split it into smaller amounts, like a 200, say you start with 200 ringgit. And then next month you invest another 200 ringgit, and the next month you invest another 200 ringgit. And when you do dollar cost averaging, this is what we call dollar cost averaging, because you are investing same amounts and you spread it across, say, 5 months, and you will be buying at different prices. And as a result of that, you get the average price. So it would be good if you do that, then it kind of smoothens out your return. And instead of, and you will notice that the swings, your portfolio volatility or fluctuations can be a lot lesser as compared to you buying it at one point. Because if you buy it at one point, it's either you're lucky, you get it right, or you could be, damn wrong, because you could have entered at the high when everybody says, hey, buy this, and then you jump into it. Okay. And then determine your review period, whether you want to look at your portfolio on a yearly basis, semi-annually, or even quarterly. I've read an article, very interesting article, a couple of years back, where it says that, you should not be looking at your statement every day. Some people just like to see their money, right? But don't do that, because if you do that, emotions may take over. Right? So if you know very clear that you have an objective, try and be disciplined. Try not to react, because when you react, most of the time you could be wrong. Okay. And then rebalance. What we mean by rebalance simply means that when, say, for example, your initial intention is to have 50% in shares and 50% in bonds. And when one asset class do well, so for example, if equities have got a bull run, and from 50% allocation, it is now becomes 70% of your total portfolio. All right. As a result of the price increase, what you can do to rebalance is to sell some of the stocks that you own and then move the allocation to bonds. That's an example. Okay. So I think that's all I have for today. So if you're interested to download the Allocate Plus, feel free to just scan this QR code and then get to, the Play Store. Okay. Faris, I'm done. Would you like me to? I think I've answered the questions along the way as well.
Thank you for such an eye-opening session. I think now we will move on to the Q&A session. Min, can you start to share the screen for the Slido?
I hope I didn't bore you guys over such a long session of me
No,
talking
you
for an
definitely
hour.
did not. I enjoyed it.
Min, can you switch to the Slido?
Maybe when you while you're sharing your screen, let me just tell you a story. So just now I spoke about us. I spoke about you know, us trying to be trying to time the market and don't let emotions take you know, your the way, right? So I had this encounter, you know, having 12 years of experience in the market. Last year in March, we know that there was a sharp correction in the stock market. And initially, I thought I was quite steady, okay? I didn't do anything. And I have a friend who kept pestering me and said that, you know, in the industry, and kept pestering me saying that, you know, hey, are you sure you don't want to do anything about it? Because the market has dropped so much. I think it's dropped 30%, you know, and for it to recover, if you look at 2007, it takes 1 year and even 3 years for it to recuperate, for the market to recuperate and go back to its peak. And initially I thought, you know, yeah, never mind lah. But she kept pestering, you know. So, and then what happened was I went in to check my portfolio. And when I saw my portfolio, I was like, oh my God, such drastic drop. And I thought, hey, if she was right, because she has a lot more experience than myself, and if she was right, then I would be stuck for years, for 1 to 2 years. And I thought, okay, I think I want to minimize my risk. And I actually moved my investments from equity to money market fund at the bottom of the market. So I sold at like a completely wrong timing. And then over the next few months, the market recovered rapidly, so fast that nobody actually predicted. Okay. And when that happens, I was like, you know, really like feel like slapping myself in my face. But of course, you know, to me, it's like, okay, it's fine. It's a lesson learned. Everybody make mistakes. So that's why I really want to advocate and say that, you know, try not to let emotions, you know, get in the way, because that is actually the most dangerous thing. Okay. Shall we take the questions?
Yeah.
Okay, so this is a lot of things to digest. Yeah, definitely. What would you suggest us beginners to do to get started on investment? Okay, if you ask me, it depends. I mean, you guys are still young. There's no rush in trying to make your first investment, right? It's not a race. What you can do is, I think first thing first, go read up. Okay, go read up on one thing that most interests you. Okay, for example, if you think that robo-advisor is the thing that interests you, go and read about what they do, how they do it. And if you are comfortable with that, I think robo-advisors is definitely a good platform for you to start. And if you if you, you know, after reading it, then you can start investing, right? There's no harm. Then when you start investing, go explore more products. Go read up about more products and expand your knowledge. And when you have more knowledge, maybe at that time you realize that, hey, maybe this product, you know, is also a good add-on to your portfolio. Then you can start investing into, you know, ETFs or unit trust funds or P2P or, you know, equity crowdfunding, whatever that may be. So I think reading. I cannot emphasize, you know, too much for that. Okay, so please go ahead and read and understand. Okay, next thing, will fintech take over traditional banks in the future? Well, I really don't know, but we do see that the trend is moving towards that side or that angle. But I really don't think that, the banks will be totally out of, place, because the traditional banks will still need to serve, let's say, the high net worth, because I can tell you, if you have millions of dollars or billions of dollars, you probably won't trust the app. I'm sure if some of your parents here probably are very, very skeptical about apps, about mobile banking, online banking. Maybe some of them have kind of moved on, and think that, hey, it's actually not that risky. But I can tell you, like for my mom is like 60 plus, and I tell her, do not get an online banking account, because with the rise of phishing emails, and if you're not alert, and if somebody just give her a call and say, hey, I'm calling from the bank, could you please give me your password or IC? And then she probably just give. So to me, I don't think the traditional banks will be replaced totally, but I do think that traditional banks will eventually move towards the fintech side. Of course, they won't be fintech, but they will definitely invest in technology to make things faster, to make things better. So today in Malaysia, if you talk about, let's say, digital banks, I think Bank Negara has opened the doors for people to come in to apply for digital banks, and there are conventional banks actually applying for digital banks. Okay, just for your info. Is fintech really transparent? I don't think so, actually. Fintech is not really meant to make things transparent. I think they are more to make things fast, accessible and fast. I wouldn't say transparent. I don't think that is one of course, they try to, but it may not be. Just let me give you an example. Say robo-advisory. As much as people say that, robo-advisors are transparent, they tell me how much they charge, they tell me how they implement the algos, but do you know whether will they really implement that algo? What do they do? Do they tweak? Do they change? Is that really the outcome? Nobody knows, right? Just give you an example. Okay, how do we be as financially literate as you? Then come join, the financial industry. So personally, I have been working in the financial industry for, I think 13 years now. I've got quite a balanced experience in the banking side and as well as the fund management side. And it kind of opens my eye to it. Of course, if you want to be, you don't necessarily have to be in the financial industry to be financial literate. You can do it if you are willing to spend the time and if you have the interest in it. Okay. How much equity versus bond should we get as a student? I think as a student, you have all the time in the world, right? Because you're not going to be withdrawing your funds so soon, unless, of course, you're just saving up to buy the latest PlayStation. If you're saving up just to buy the latest PlayStation, then maybe you just put your money into a money market fund or a bond fund for that matter. But if you think that you have a long-term horizon, I would say, going on higher weightage to equities would make sense, because you can tolerate, high risk for sure. Okay, do you think there will exist a huge bank in the future that will have all the functions that you mentioned? Well, I don't know. Maybe the answer is maybe. I personally wish that there is, because then it make things easy, right? I don't have to open account and try and have like 10 or 20 apps just for my investment. I just need one, right? That's my vision. I hope to see it one day as well. Okay, in view of COVID numbers increasing, would you suggest that we save money or should we invest? Okay, I think again it goes back to how much you have spare to invest, right? So today a lot of us actually think that okay, it depends on your own. If you ask me, it depends on your own financial situation, right? So today, if you are comfortable, say, you have a place to stay, and if you have started working, or and if you have sufficient money to buffer your day-to-day expenses, then I think you should invest. Okay, but if you want to save, do note that do read up on money market funds, because money market funds allows you to save at a rate that is close to fixed deposit and without locking in the 12 months. Because money market funds essentially tries to pool funds from different investors. Some may have shorter tenure, some may have longer tenure. And as a fund manager, when we accumulate or pool these funds, we can then invest in longer term. We can manage the tenure of all the fixed deposits. And as a result of that, we can deliver returns that are close to 12 months FD rate. But the good news is that for an investor, you don't have to lock in 12 months. It is all prorated. And if you stay for 3 months, you get 3 months worth of interest. 1 month, you get 1 month's worth of interest. So that could be an alternative way for you to save rather than putting money into the bank, because the bank's interest it's really low. Okay, so I think whether to invest in robo-advisor or unit trust funds, I think it really depends on yourself. So like I said, you can just go to Allocate Plus, you can go to Stash Away and see which one you actually like and understand what they do. Okay, which one should I get, Fund Supermart or Allocate Plus? Well, Fund Supermart is my competitor. Of course, I would say go for Allocate Plus, but I want to give you a more balanced view. If Fund Supermart offers investments for all kinds of, from basically multiple fund house. So you can find Affin Hwang's fund in there. You can find RHB, you can find Maybank's fund, you can find anything except public mutual. Okay, so if you want a variety, more products offering, then I think Fund Supermart is a good place to start. But Fund Supermart does not have the low investment amount that we have. So Allocate Plus, we bring our investment minimum investment amount down to 50 and 100 ringgit. But for Fund Supermart, you need to invest 1,000 ringgit. And of course, you can also compare the charges that we charge. I think we are quite comparable, if I'm not wrong. You can do your own comparison. So again, at the end of the day, it depends on you. If you want a lot of variety, then you can go to Fund Supermart. If you don't mind, the only investing in Affin Hwang's fund, but it allows you to invest at a lower investment amount, then Allocate Plus could be an option for you.
I think that's all for the questions from participants. Thank you for posting your questions and sharing your curiosity with everyone. So for now, we will move on to the photo shoot session. So if you don't mind, please turn on your webcam for us to take a picture of everyone. I'll wait half a minute for you to turn on. Okay. On my count, 3, 2, 1. Okay, thank you. So unfortunately, we have reached the end of our session. Min, can you start the screen again? Thank you. Yeah, So on behalf of MSGA, thank you, Ms. Lee Choo, for joining us today and sharing with us all the knowledge. Before you leave, do remember to fill up the feedback form for improvement. Yeah, we will send in an email with a recording of this session as well as a certificate of participation to all participants who have joined us for all 3 sessions. So that's all for today. Thank you and see you in our next events from MSGA. Thank you, everyone.
Thank you, everyone. And thank you, Lee Choo, especially.
Thank you. Bye-bye. Take care and stay safe, guys.
Have a good day.
You too. Bye-bye.